Have you ever wanted to look under the hood of a big company and see what's really going on with its finances? Well, that's exactly what we're going to do today. We're putting Titan Company Ltd on the examination table for a full financial health checkup. We'll check its vitals, test its strength, and figure out what the market thinks of its overall health. All right, let's get right into it. So, first things first, what exactly is Titan? Now, you probably know them for their watches, but their business is actually way broader than that. We're talking jewelry, eyewear, and you can even see apparel and accessories in the mix. This diverse portfolio is a really key part of their story. So keeping that in mind, let's start our checkup. You know, the first and most basic vital sign for any healthy company is growth. I mean, is it getting bigger? Are more people buying its stuff year after year? It's a simple question, so let's check out Titan's top-line revenue. And the answer is a huge yes. Just look at these numbers. Back in 2019, revenue was sitting just under 200 billion Indian rupees. You fast forward to 2023, and it skyrocketed to nearly 380 billion. That's almost double in just 5 years. That is some seriously impressive growth. But you know, it's not just about the total growth. It's about the speed. The pace of that growth is what's really interesting here. You can see there was a bit of a dip, but just look at that rebound. In 2023, the company grew by almost 19%. This isn't just growth, it's accelerating growth, which tells you there's some real momentum behind the business. Okay, so the company is growing fast. That's great news. But is it actually making any money from all that new business? That brings us to our second test, and it's a big one: profitability. A fantastic way to measure this is a little metric called return on equity, or ROE. The easiest way to think about it is like this. For every single dollar the owners themselves have invested in the business, how much profit does the company kick back each year? Simple, right? A higher number is always better. And wow, Titan's ROE is really impressive. You can see that dip in 2021, and hey, that affected a lot of businesses, but look at the recovery. By 2023, it hit over 30%. An ROE north of 30%, that is a sign of a highly profitable, super efficient business. So what does this tell us? It's not just growing, it's growing very, very profitably. And here's another angle on that profitability: the operating margin. This number, 11.71% for 2023, basically tells us that for every 100 rupees in sales, Titan makes more than 11 rupees in profit just from its main business, before things like interest and taxes. This really confirms that the company has a strong, profitable core. Okay, so what have we got so far? A fast-growing, very profitable company. But the question is, can it weather a storm? Test number 3 is a bit of a stress test. We're going to check its financial foundation to see just how stable it really is. First, let's check its short-term health. On the left, we've got its current assets. That's all the stuff it can turn into cash within a year. And on the right, its current liabilities, basically the bills it has to pay within a year. And, as you can see, its assets are more than double its liabilities. That is a very healthy cushion. It means Titan can easily cover all its short-term bills and still have plenty left over. But what about long-term risk? For that, we turn to something called the debt-to-equity ratio. It's really simple. It just compares how much money the company has borrowed to how much its owners have actually invested. A higher number here can mean the company is relying more on debt, which can mean more risk. Now, this is an important one to watch. What this chart shows is that Titan's debt-to-equity ratio has been climbing, hitting almost 79 in 2023. Now, this isn't necessarily a big red flag. Companies often use debt to grow faster, and that can be a smart move. But it does mean it's taking on more financial risk. It's definitely a key thing investors are keeping a close eye on. So we've checked the vitals. Growth is strong, profitability is excellent, and the balance sheet looks solid, even with that rising debt. So what's the final diagnosis? Let's see how the stock market actually values this company's health. And this brings us to the big question for any investor, right? Given all these strong fundamentals, does the stock market see Titan as a great deal? Or is all this good news already baked into the price? Well, this slide pretty much gives us the answer. We're looking at the price-to-earnings ratio, or PE, which just tells us how much investors are willing to pay for each dollar of profit. Titan's PE is nearly 82. The median for similar companies? Just 34. That is a massive, massive difference. So here's the bottom line. The stock market isn't just rewarding Titan for what it's already done. It's paying a huge premium because it believes the company is going to keep growing at a fantastic rate for years to come. You could say this high valuation is a huge vote of confidence from investors. And that leaves us with our final thought. The health checkup is crystal clear. Titan is a robust, profitable, and rapidly growing company. No doubt about it. But the market knows this, and it has priced this stock for perfection. So the ultimate question isn't about its health today, it's whether its future can possibly live up to these sky-high expectations.